Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. I'm very pleased to say that joining us on this programme, Howard Mark joins us for more. Howard, welcome to the programme, sir. We want to start with a central question that you pose yourself. Why are asset prices so strong in the face of what you view as net negative developments? Howard, can you share your thoughts with us?
I'm glad to be with you this morning. Of course, as the quote you just put on the screen indicates, this is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And the outstanding reason, I think, is that there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen. Whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we're probably in the early days of that.
When you talk about liking, Howard, maybe liking these assets a little bit too much, can you put into perspective the last time you saw this type of environment that left you thinking maybe some of the opportunities aren't as great when it comes to buying some of these assets at current valuations? Is there another time that this sort of reminds you of in any capacity? Well, I guess, Lisa, the last time was probably around 97, when the market was kind of falling in love with tech stocks, and the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet, Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. So remember, I said we're in the early days. We're not at a critical, at a nutty valuation. I'm certainly not ringing the alarm bells, as the quote that you had on the screen said. No reason to think there'll be a correction soon. But the point is that things are expensive. They may go on to become more expensive, but the fact that they're expensive, it should not be lost. And Howard, I think a lot of people point to, in terms of the echoes of the late 90s, the tech sector of the market as being the most overvalued. What I thought was so interesting about your memo is that wasn't your take, that wasn't your bigger concern in the market at a time when people are counting on a certain robustness of growth and a certain kind of inflationary backdrop. Why is it that tech isn't the focus of your concern this time around? Tech contributes to the aura
that surrounds the markets. And a lot of people have been citing the fact that the so-called Magnificent Seven, stocks like Amazon and Alphabet, have been contributing disproportionately to the rise, and they're responsible for more than 7 stocks. Their dollar gains have been responsible for more than half of all the gains in the 500 stocks in the S&P, 7 out of 500. But they're great companies. They're at high valuations. I think that I can't say those valuations are excessive. But the other 493 stocks are quite highly valued, not as highly as the Magnificent Seven, but nobody says they're the same quality company, quite highly valued relative to history. And it is the fact that high valuations are being applied to more average companies that I think is more alarming than the fact that exceptional valuations are being applied to exceptional companies.
Howard, there's a quote you use in this memo. I enjoyed this quote. You said, "He who knows only his own side of the case, knows little of that." And then I worked through the rest of the memo, and there was a conclusion there about credit. And I just wonder, sir, whether your focus on equities in this note offers you a greater perspective on how much value is offered in credit right now.
Well, it's as John Stuart Mill said, and I believe it was 1859. You have to know all the sides of the story to understand whether your side holds water. And I cite the bull case there for why the market isn't overvalued. I think that's part of the job. But as you say, my conclusion is that I'm not. As I said before, I'm not raising an alarm bell, but I do think it's time for some caution. And, this is a little bit of what we call on Wall Street talking your own book. But, what I do, what Oaktree does, is mostly something called credit, buying the debts of companies. And debt is inherently more defensive than equities. And you have a promise of payment. You know what your return will be if they pay interest and principal as promised, and most of the time they do. So I just think that this is a time to put a little more defense into your portfolio, and investing in credit as opposed to equities is one way to do it.
Is it still defensive, Howard, if you're looking at credit spreads that are the tightest since 1998? I'm looking at investment-grade credit spreads, which are thought to be a more defensive part of the credit market. I mean, does that sort of question what it means for it to be defensive when the valuations are high there as well?
Well, first of all, Lisa, debt or fixed income or bonds or what I call credit, all different words for the same thing, is different in nature from equities because you do have a promised contractual rate of return. And you can say that the promised contractual return isn't as high as it has been historically, or the increment that it provides over treasuries to compensate for the credit risk isn't as high as it has been historically. But you can't say that they don't promise 7.5%. And a promise of 7.5%, you're going to pay some fees. You're once in a while going to encounter a credit loss. I think it's highly likely to provide, let's say, a return in the 6s over the next 10 years. A contractual guarantee approaching something in the 6s over the next 10 years is, I think, more defensive than being in the stock market at these elevated valuations. That's the point. You just said tighter than they have been since '98. If you looked at where they were in '98, and you hypothesized that put an investment in a portfolio of high yield bonds in '98, how did you do over the last 17 years, 27 years? And I think you did fine. That's my point. it has a high probability of doing fine, whereas stocks, if the valuations are elevated, have some reasonable probability of doing less than fine.
Is the United States still the focal point for defensive investments?
I think I said in the memo that I think the U.S. is still the best place in the world to invest. The things that make the U.S. exceptional, the spirit of innovation, the free markets, the rule of law, the capital markets, the growth and dynamism, the great companies, these things are still all true. But as I said in the memo, we're the best place. We may be a little less best than we used to be. The world is thinking that maybe the U.S. is a little less best than it used to be, and I can't argue against that. I mean, fundamentally, as an investment environment, I think things are a little bit deteriorated.
Is there a place where you see has more opportunities right now just based on valuations and based on maybe a firming up of contract law and other aspects that really lead to a robust investment backdrop?
Well, as I say, I still think we're the best place in the world to invest. We're a great car at a high price. You can get some cars around the world that are not as great as ours, cheaper. Which do you prefer? Less good at a cheaper price, or better at a more expensive price? Other parts of the world do not have our dynamism. And lots of places in the world are overregulated compared to the United States. But if they're on sale relative to the U.S., it's not unreasonable to want to have some representation there.
Stay with us. More Bloomberg surveillance coming up after this. Eugenio Aleman of Raymond James writing the following: inflationary effects from tariffs should start making inroads into those nominal retail numbers, and we should expect to see weakness in consumer demand during the rest of the year. Eugenio joins us now for more. Welcome to the program, sir. What's your read on the US consumer? Let's just build on what you said there. And how broad-based will that weakness be?
Yeah, we have been seeing weakness in the U.S. consumer for a while. The first 2 quarters of the year were relatively low, weak. And as we expect the full impact of tariffs continuing to make inroads, we are expecting the consumer to continue to slow down. So our third quarter and fourth quarter expectation is very, very weak, very, very close to recession. We are still not calling a recession. We have 50% probability of recession, but it is a very smooth slowing down of the consumer. There is no falling of consumer demand. But it is weakening. We have seen employment numbers weaken considerably, and that is going to continue to keep the consumer contained.
Can we focus on the potential for further bifurcation within the consumer? Eugenio, this came from the Bank of America Institute, and they said total credit and debit card spending per household increased 1.8% year over year in July, the highest growth rate since January. So a bounce back in spend in July coming through the summer. But they also said this: the difference in wage growth between higher and lower income households, the largest since February 2021. Is there something more regressive about the policy effort of the past few months that you see playing out in a much more negative way in the months to come?
Yeah, it is clear that tariffs are very regressive, affect the lower income individuals or households compared to the higher income. And we have seen this wave of a splitting consumer, let's say, in terms of income for a while. I mean, we also have student loans that are going to have to be repaid again. So those spendings are going to come down on discretionary side of the economy. So yes, I mean, we are concerned that this bifurcation of the consumer through income levels will help to weaken the consumer even further.
How much do you see some of the retail sales data that we've been getting is somewhat clouded, Eugenio, given the fact that inflation has been present? You have seen a couple of key goods really see pretty significant inflationary pops, and that's included in the absolute number that people then say, look, it shows the consumer is strong, the consumer is robust.
Yeah, I mean, the biggest issue with retail sales is that they are nominal, correct? The DEA used to calculate some real retail sales, but they don't have enough resources, so they no longer calculate them. So every time that we see nominal retail sales, we say, wait a second. Yes, it was relatively strong in July, but you have to take into account that most of it is probably price increases. So that is one of the reasons that we say that the consumer demand has been slowing down. So you have to take that away, the increases in prices. We are seeing some increases in prices. A third of consumption is goods. So those are the ones that are most impacted by tariffs. And they are goods that affect the lower end consumer more than the upper end consumer. So it is concerning. We don't see a crisis. We don't see something falling off right now. But the shock from tariffs is going to continue to make inroads into consumer demand.
Stay with us. More Bloomberg surveillance coming up after this. Eric Freedman of US Bank writing, as long as capex continues and technology diffusion occurs at a measured pace, we see further upside, but would not mind a pause that refreshes. Eric joins us now for more. Eric, welcome to the programme, sir. Last time we spoke, around a month ago, I remember you were maintaining that overweight, risk-on posture. Eric, are you maintaining that posture going through summer?
Yeah, Jonathan, we are. Great to see you as always. I think that our viewpoint is certainly trees don't grow to the sky. And I think a level of skepticism around, leads to a great point made about the return on capital within AI. That for us is really the big factor. We think that with respect to technology, we are seeing that diffusion pick up. In other words, we're seeing more access to AI technologies across a broader plethora of companies, which is a good thing. At the same time, though, companies have to make money. This is about return of shareholder capital. And so you can't just have a plan where you want to spend a bunch of money on AI. There needs to be some evidence, if you will, of return. So we think that CapEx is a good guide. It's not the only guide, but we're starting to see more companies talk about those returns on their capital deployed, which for us is still a positive. So again, we're still risk on. We think consumers hang in there. We think CapEx continues. But again, we would not be surprised to see a bit of a pullback, which we'd likely be buyers of, especially as we get deeper into the doldrums, if you will, pre-Labor Day.
So you've got a pro-risk bias, quite clearly, and you've had that every time we've spoken over the last several times. What would begin to constrain that pro-risk bias for you, Eric? What could you point to specifically?
I think two things. Number one would be, Jonathan, the consumer rolls over, which we can't discount. We like to say that we have a working thesis mentality about consumers. A lot of concern about, did we see a huge pull forward in demand around the Liberation Day announcement and the weeks shortly thereafter, and will that return? In other words, will that demand actually resurface? We have a couple of data points we can look at. Number one is back to school sales, and then number two is what we're hearing about the holiday shopping season. So we'll have some good evidence. Right now, our high frequency data checks, things like TSA data, things like open table bookings, are still very robust. So consumers are not rolling over. The second area where we could be wrong would be companies actually don't use this opportunity with a bit more tariff clarity to hire people. And again, we do think the labor market softness, it's been very well documented. That for us is a red flag. So those two elements, consumers pulling back, but then also the notion of will businesses actually come back to hire folks now that we have a little more tariff clarity? That for us would be a bit of the concerning points that would take that glass half full thesis to task relative to where we are right now.
It seems like the potential for disappointment is in the 493 based on what you just said, not necessarily the Magnificent Seven. You never said in that entire risk paradigm the idea that suddenly we're in a bubble in tech valuations and that it would crash as people lost faith in just how much artificial intelligence could actually do. Why is that not necessarily a concern for you in the same way that just sort of the more humdrum aspects of just a slowing consumer would be?
Yeah, I think that's a very thoughtful challenge, Lisa. I mean, if you look at the broader marketplace right now, and you look what's really developing from a core spend standpoint, we need to see a development beyond AI and cyber spend. That's something that is a very played out thesis. Again, we're wary of being involved for too long. I think that's something that gives us, again, some level of skepticism about the rest of the market's participation. One thing that I want to really emphasize that I think is probably undercovered is that cash flows are actually becoming more valuable. If anything, when we look at our discounted cash flow models, when we're evaluating the other 493 companies out there, there's the expectation that Fed funds goes down to 3% by the end of calendar year 2026. That's a pretty significant development. Again, that's not necessarily new news, if you will. I mean, the forward curve has that pretty well priced in. But when we're discounting cash flows, we're using a much lower interest rate, which makes those cash flows more valuable. So if anything, we think that should the Fed continue with a more measured, gradual reduction for a prolonged period of time, again, the move from 4.33 to 3% on a discount rate, that has material impacts on stock valuation. So I think if anything, Lisa, what would be another challenge, if you will, would be if the Fed decides to be more incremental. If the yield curve doesn't have that twist shape and in fact the front of the curve remains more elevated, that would make that 493 less valuable. Because we think that will likely be the outcome, the Fed will be measured but still bring front rates down. That makes the other 493 more attractive, even with more prosaic sales growth.
This is a reason why so many people are thinking that 10 a.m. on Friday Eastern time is going to be so pivotal for equity and bond markets, given the fact that potentially Fed Chair Jay Powell could come out and say, in September, we're going to cut, or in September, we're not going to cut. He's not going to say either of those things. What are you actually going to hear that will give you a sense of whether this market has baked in too many rate cuts or has gotten a little bit overly excited about the pace of the easing cycle that's ahead?
I think it is very much a horse race, Lisa, about which risk is the Fed more focused on. Again, the labor market is softening. That is something that we think has been evidenced for a couple of months, a couple of quarters, versus what about this inflation issue? Is, in fact, inflation going to be more ephemeral in nature? So I do think that the labor market, is sort of having the lead, if you will, right now, versus a little bit of a viewpoint that perhaps the Fed is rounding down with its inflation expectations. Again, the Fed has had many opportunities to come off that 2% long-term inflation target, and they haven't budged. We do think that the Fed is actually rounding down, if you will, saying, hey, if we see something in the mid-twos, that's probably okay to start or at least to continue the rate cutting cycle. But again, I think that the terminal rate, Lisa, probably the last thing I'd say is of utmost importance to us. Again, while we are very focused on where the front of the curve may be in 2026, we also care a lot about how long it'll actually be there. The Fed has been very stealthily increasing their terminal level of Fed funds. That has material implications for equity investors like us. If we're discounting, again, a higher terminal rate, that's not a good thing. So we think that two things are really important. Number one, how long will we actually be at that terminal rate? And number two, which of those two risks is the Fed more focused on? We think that right now the labor market softness is getting a little more attention from the Fed versus inflation. inflation, which has been, again, well in their sights for some time.
All right, let's focus on inflation. Let's just finish there. We spoke to Jim Caron and Morgan Stanley just yesterday. Now, as I ask this question, I do understand that stocks are still close to all-time highs and we're trading at a pretty elevated forward multiple. But Jim had this to say: inflation is acting like a guard dog keeping unrestrained bullish sentiment at bay. But what if the dog doesn't bark? Then markets might be under risk. Eric, for a man with a pro-risk appetite, pro-risk bias, do you have some sympathy with those lines coming from Jim Caron and Morgan Stanley?
Oh, absolutely. I think one great imagery from Mr. Caron in terms of that visual. But I think that the inflation issue is a material risk. And again, we don't want to just whistle past this idea that perhaps inflation is going to have some normalization effect just because that's what markets currently expect. If you look at the great reporting that your team has done, companies right now are still eating inflationary pressures, not just on the goods side, but also on the services side as well. That may not persist. We could see an about face where companies say, hey, you know what, I'm in a thin margin business, and other companies are also passing through inflationary risks, so we'll do the same thing. If that actually occurs, Jonathan, then that bark may be a lot louder than we think it will. Again, we do expect, again, even just looking at differentials, look at forward estimates for inflation in the U.S. at 2.5% to 3% versus Europe and EM at sub 2% out another 12, 18 months. That's a differential that this administration, as well as companies, can't maintain indefinitely. Something has to give. Again, we do think that inflation will bend but not break, and we're a little more, I think, optimistic about inflation estimates coming down, but we certainly have to respect the case if that, of course, is wrong.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.